Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hi Lee, good to be here. It's been a while, I know. It's been a bit of a break since our last one.
It has, hasn't it? And, apologies to the audience for that. But we've become a little bit more news-driven, didn't we? And
Yeah, I didn't think it was worth us just hanging out the same old news and same comments. So it's more reactionary, and we've had a lot of results. So I think that's been a good driver as well. A lot of year-end results, big quarter-end results in the US from some of our bigger companies. So I thought it was a good opportunity.
yeah, Ultimate Stocks portfolio. You want to start there, Chris, with some of the AI-focused tech giants?
Yeah, I thought that was worth mentioning. As I said, we've had earnings season. The Ultimate Stocks portfolio had another pretty good year last year in 2024. It was just marginally underperformed the S&P 500. I think we mentioned that before at the year-end podcast, which you can listen to. But yeah, the Ultimate Stocks, what's really was emphasized by all the recent results is this huge amount of money going into AI. And these are staggering sums of money. Google said it would be spending 75 billion on capital expenditure this year. That was compared to 52 billion the year before. These are huge. So the question is, how can the small players realistically compete? So if you're an investor in companies talking about investment in AI, realistically, have they got a chance? Unless they've got something very special, it looks a bit of a challenge. So who's going to be the beneficiaries of all these things? Google, Alphabet's one of our ultimate stocks, but some of the other beneficiaries are equipment maker ASML. That's one of the newer holdings in the portfolio. They make all the chip making equipment. So they're going to be big winners. And of course, we got our friends Nvidia, which we've held in the Ultimate Stocks portfolio for a while. It's had a bit of a volatile time lately because of fears over this DeepSeek rival. But yeah, if you're going to be in this AI space, our view is you've got to go with the leaders, the market leaders, and the cash-rich leaders who can afford to spend sums, and it doesn't make a huge dent in their balance sheets. It's interesting, one of our other stocks, Apple, is taking a more sort of cautious approach. So we've said that Google is spending 75 and having spent 52 billion. Apple's capital expenditure was only 2.9. I mean, this is a huge company making loads of cash, a lot of which it's returning to shareholders, as is Alphabet and with its share buybacks. But Apple's, this is a drop in the ocean relative to the others. But Apple's still going to be a big winner because how are people going to really be accessing this, all these AI initiatives? Probably most of them through their smartphones or tablets or whatever, aren't they?
They're almost signaling by the amount of money they're investing on it, a different kind of bet on it, would you say?
Seems so, doesn't it? They told it, we'll tiptoe a bit, we'll see what everybody else is doing.
Yeah.
And we're ready and waiting to move when we need to, but we're not gonna show our full hand quite yet. I think it's quite interesting. And Tim Cook's a very canny operator, and he is an operations man. And he's proved himself. Tim Cook, that's the CEO of Apple. He's proved himself to be incredibly adept at the political piece as well, tiptoeing around China and the US and tariffs. He's been in this game a long time, and it's quite interesting their approach, as you say.
And moving on to another winner as well over the past few years, which is Garmin. It's been a long time part of the Ultimate Stocks portfolio, hasn't it?
It has, yeah. And the interesting thing about this, just leading on from Apple, when Apple launched the Apple Watch, I look back on this, and I think it was 2015. Everybody thought Garmin's future was in doubt. So our shares fell. When the Apple Watch was launched, we thought, oh, crikey, Garmin, smartwatches like that, they're finished. It's all over. And in fact, their shares dropped. Since then, they've risen 370%.
Wow.
And every year, you talk to people, oh, Garmin, navigation watches, activity watches, who needs them anymore? You've got Apple watches. They're dominating the market. This company is doing just fine. It's got this history of innovation, keeps on plowing money into new products. It operates lots of different markets, sports, outdoor. It's really nifty. It's even got a system that can autopilot planes, land planes, a retrofit system that can go into light aircraft. It's got phenomenal history of innovation. And so don't write it off. And recent results were absolutely fantastic. Revenue in the last quarter was up 24%, so 1.59 billion. Absolutely brilliant.
So how long has it been in the Ultimate Stocks portfolio then?
We've had this since inception. So what's that? 4 years, something like that. Right. So it's been ever present. Had a little bit of a rocky patch, but bang, it's continued to deliver, and exciting little business.
So I'm just curious, given obviously the rise of smartwatches and the talk around smartwatches, end of Garmin, etc., you obviously still decided to think, no, actually, there's something here with Garmin, and we can see that this is going to be a worthwhile investment and proven correctly. So what was it that drew you to it circa 4 or 5 years ago then?
The real thing about this is the bit I've mentioned, the ability for this business to reinvent itself and the entrepreneurial part of it. Because way back, do you remember Garmin was most known for in cars when you had it as a standalone navigation device in a car before they were integrated into
Sat
cars
navs,
with
wasn't
sat
it?
nav.
Sat
Exactly.
navs.
So you can imagine this business was really flying in that area,
Mhm.
and probably and then they probably thought there was an existential threat to this entire business because cars were they were fitted into the build, so it wasn't a standalone product. But it's demonstrated the ability to reinvent itself again and again, and it's got these four distinct operating segments: fitness, outdoor, auto, aviation, marine, or five, sorry, marine. When one's lagging a bit, the other one can come through. When one's dormant, it's still there, still present, much as auto still is. So it has a chance still to rise again. And we like those little divisions. Albeit fitness and outdoor are sort of running tandem a little bit more, but that's what really appeals with this company. It ticks a lot of the other key financial attributes, if you like: great operating margins, great cash flow, great returns on capital. But it's that innovation that's really enhances our sort of look at it.
So the metrics were there obviously originally that you obviously look for, which you've spoke about at length on these podcasts. To summarize, the ability to keep reinventing itself, that's the
It is,
narrative
yeah.
behind it.
And it's a good point you sort of alluded to there, because whilst there are always key financial metrics, and many people just invest on that basis, you have to sometimes look at the underlying market because, yeah, those metrics look great, but are they sustainable? A business making outstanding margins is going to face competition, blah, blah, blah. Are they sustainable? What's going on at the heart of the company to suggest to you that this business can keep going? This, for us, Garmin has those other attributes that attracted us.
Perfect. Should we move on to the income boosters? More of a focus on dividend payers, isn't it? This
Yeah,
portfolio.
absolutely. Yeah, so no US stocks in this. It's just UK big dividend payers, and we'd hope this portfolio to be very much a buy and hold kind of thing. It hasn't worked out as well as we hoped. It's still at the yield, and it offers a great dividend yield. It's up at 7.8%. That's largely because we've tweaked it to have some focusing on higher yield in the current environment. And we've had to do some changes. We sold out of a business called B&M European Value Retail. We're just a bit worried about its positioning. Had a profit warning, pressures on rising staff costs, net debt's climbing, but they're still committing to a special dividend. There are too many red flags for us. The CEO's going as well, which isn't after a relatively short period. So we've taken a view now rather than to ponder, to just take some action and get out of that one. And we've also got out of probably a holding we've had in the income boosters again since inception, WPP, the advertising group. Again, it all looks a bit stretched. The space looks very tricky. As WPP CEOs alluded to, the AI bit in their market is really game changing, and they're having to invest huge sums as well. So we're a little bit wary of that one. And obviously the pullback in advertising spending now, and everything's being funneled, isn't it, through Google, Facebook, Amazon. They're sucking up all the ad dollars. But yeah, we decided to move on from there and replace with the two other stocks. Those wanting to know what those are, they shall have to look at our income boosters portfolio. But we've given you a sort of taster of our logic. Our psychology now on this portfolio is to move. We sense fear, we see problems. If we're at all uncertain, we're cutting and moving on.
So can we anticipate more movements over the next sort of coming months in
I
income
hope not.
boosters?
I hope we're quite settled now with the portfolio. We've rejigged things a bit over the last 6 months, not just these two changes, but just prior to the year end, we also made some changes to enhance the yield. And I think we're pretty settled now. Hopefully they're going to come deliver some decent performance.
Is that a reflection of your concern about the individual companies not performing to what you expected?
I think you've got global economy in terms of WPP. That's very much a global player that's gone through a bit of a shake-up over recent years. B&M, UK economy focus, is it stretching itself? We don't quite understand when companies overcommit to payouts when clearly their underlying business is struggling. To us, that suggests they're trying to satisfy shareholders, and doesn't reflect the real trading environment, which is a bit of a concern. So we prefer to move on.
Shall we move on to AIM and some smaller companies? A couple of good updates, haven't we, from some Bonkers bargains?
Yeah, look, there have been loads of good updates from AIM, but you wouldn't think it looking at the performance of the shares. It's been a terrible start to the year again for AIM and smaller companies. Nobody's interested. There have been lots of money flowing out. But in the meantime, the vast majority of companies we're following are announcing decent results, decent updates. There are a few exceptions. We'll lead on to some questionable reporting as well. But yeah, one of our Bonkers bargains, Time Finance, specialist finance provider, just keeps on benefiting from upgrades. It's done a really good job over the last few years, and it's got a huge market to address. Valuation's dirt cheap. Probably the one thing that doesn't attract people is the fact it isn't giving a dividend yet, because it sees a growth opportunity and it wants to use its available cash to support growth. So we'd implore you to look at Time Finance. I've got a personal stake in it, our firm has, and it's a nice little business that's proving to getting a real strength in its niche market. So yeah, Time Finance, nice little business. Impax Asset Management has been suffering. It's had a big outflow of funds. It lost a mandate, an investment mandate to St. James's Place. Impax is a specialist investment manager focused on transition to a sustainable economy. So it's a sort of ESG focused investment manager. And look, the recent update was much as predicted. The shares have absolutely cratered over the last few months. The valuation looks incredibly favorable. Is it the end of its really life? That's what it's implying, really, given the share price moves and what everybody's thinking. You're getting a single-digit earnings multiple. You're getting a near 15% dividend yield in this stock, near 15. It's got heaps of cash on its balance sheet. The dividend is just about covered by free cash flow. The big decision is, will it decide to use its cash and its available resources to do other things rather than pay a dividend? But I would implore people to look at it at this level. It looks just very cheap. And the cash and investments represent around about 40% of its market capitalization. You're getting the business on that basis for circa half price. But yeah, this was a star performer a few years ago. Now everybody's distancing themselves from the ESG space, and they think the game's over for Impax. But I would suggest that it's got some way to go. Founder, CEO and founder Ian Sim, he's clearly confident. He bought another 40,000 quid's worth of shares, and he owns 7.5% of the business.
Do you think the shift in that perception is a result of a new president in the White House?
I do. I think he's got, I do. Yeah. It just changed the whole sort of outlook for this kind of investing in the States. Yeah. But yeah, have a look at it. Impax, been a nice business, superstar performer many years ago. Is it really over? We think not. We think it's got the valuation and the pretty good value to us.
Yeah. And another one, Quartix Technologies as well.
Yeah, Cortex is a provider of now subscription-based vehicle tracking systems, so telematics for small contractors, people running fleets of 5 to 50 vehicles. I think generally is its sweet spot. It's had a bit of a hiccup a year or so ago when the previous CEO decided to buy a business, which they subsequently wrote off within 6 months. The founder has returned a year or so ago. He's refocused the business on organic growth, which was always the game. And the latest results suggest they're doing pretty well, growing fast in France, growing fast in new European territories. They've got an opportunity in the US. It's taking a while to get going in the US. But yeah, look, business addressing a huge market. The thing we've always liked about this, very honest reporting, very timely reporting. It gets the results out very quickly. Great shareholder alignment. The founder, Andy Walters, has significant stake. He's now back as exec chairman, as I say. Yeah, so keep an eye on Quartix. The valuation, like many stocks on AIM, looks very fair at the moment as well, given share price falls. So yeah, we'd implore you to look at Quartix. And we feel it's the sort of business that should be rewarded for the way it reports to shareholders, unlike others who seem to do their best to pull the wool over our eyes.
What sort of examples can you share that's less than honest reporting, pulling the wool over one's eyes?
The way companies report now, you generally get a little bit of a summary headline statements in their results and their preliminary results, and then you have to dig into the detail to find out what's really going on. Most people haven't got the time to dig into the details. They just look at the headlines. One company this week, I won't mention names on these, but one company this week didn't mention anything about its revenue, its sales, its income, its earnings in the headlines. All it did was make some kind of give some ambiguous comments. You had to dig right into the detail, discover its revenue had fallen 11%. It was profitable again at the adjusted EBITDA level. The minute we see that profit at the adjusted EBITDA level, we want to dig into the details. Evidently, it was clearly loss-making, because when minute adjusted EBIT for us, well, our hackles are up. But yeah, so you had real lack of clarity there. It actually, free cash flow, it was well down on the free cash as well. But they weren't telling us any of that. So they don't give you the facts. Another company which decided to tell the market that in its free cash flow announcement, that free cash flow, looking into the detail, conveniently ignored interest that it was paying. How you can ignore interest, when, especially when it is as substantial as it was in the case of this business, is beyond me. Interest was a huge bill, and it is a real payment of cash out. So how you can give a free cash flow number without interest is just ludicrous. Some companies choose to exclude payments for leasing costs in their free cash flow. Again, that's ludicrous. They need to pay rent, which are now, i.e. leasing costs. They need to pay bank interest. Those are cash. That's part of their free cash flow. So they're just trying to, as I say, pull the wool over investors' eyes by ignoring these sums. It's just dishonest. And we put out a note recently. What we had, the headline was, "What's the point?" Honestly, it's getting to that extent. What is the point of financial reporting when they're not actually following the rules? It's a bit like playing golf and cheating all the time and moving a ball and saying, "Oh, I shot around a 59 today. Yeah, but I moved my ball 3 times. I went in a bunker, but I didn't think I should be in there. I didn't think the bunker should be there, so I'll ignore that bit." Why don't you just tell us the rules are there, accounting rules are there? Why don't people follow them? Why isn't everybody on the level playing field?
In your multi-decade career of investing, have you seen a trend to it getting worse, or is it much the same? Has it always been like this? Or
No, it's getting worse and worse. It's just fairy tale. They might as well write works of fiction, half these people. The way they report results, some of these companies might make more money writing works of fiction. It's just rubbish. You've got the Financial Reporting Council. You've got people setting rules and telling people to report a certain way. And the management teams are basically saying, these are the things we're supposed to do, but we like to show you things a different way. And then, of course, they can do exactly what they like. And it's just caveated by lots of notes and explanations. But you start with the headlines, and often the headlines are the things that the press pick up on. But yeah, it's just rubbish. Absolute rubbish. They're just trying to pull the wool over investors' eyes.
It's probably a reflection. It's not just financial reporting that has trended that way. Social media has probably been a huge contributing factor, hasn't it, to just headline grabbing statements. It's across all multiple sectors and industries now, isn't it?
Snippets, which often say all they do is tell you what the teller wants to tell you, not what the facts are. I'd be quite looking forward to somebody saying, "Look, we had a rubbish year. It was terrible.
But this is what we plan to do."
To correct it, but be honest, say, "Look, it's been terrible. These are where our problems are. We're going to sort them out. We're going to try and sort them out. We're going to do our best to sort them out. And I'm going to take a salary cut." And that would be refreshing, wouldn't it?
Yeah, but you know what the news outlets would run with? "Oh, so-and-so said it's been a rubbish year."
I know. That's it.
I know. The CEO is going to take a salary cut XYZ. So-and-so's had a rubbish year. End of the story. So
I know it'll be a brave move, but I just think there's got to be some return to consistent reporting and everybody following the rules that have been laid down, rather than, if you continue the analogy, just chuck their ball out of the bunker every time they see a hazard in the way.
The thing is as well, when a trend starts trending one particular way, the envelope is always consistently pushed wider and wider, isn't it? So as one starts doing a particular type of behavior or action, others then go, "Oh, so-and-so's been pushing the envelope a bit. Wonder if we can push it a little bit." And then they get away with it. And then the next one and the next one. And before you know it, the pendulum swung so far over to one side that people have lost control of what was actually good.
And it's even leaked into some very old established businesses. There's one well-known maker of a very sweet blackcurrant concoction based in the north of England. Based in the north of England. Not the major brand, but maybe the second one anyway.
Yeah.
They have incurred so many exceptional costs. I pulled them out as adjustments over the last 3 years. I think I totted up the exceptionals were equivalent to about a third of their pre-tax profit in aggregate. I think it was something like 24 million quid. As you said, they got used to it, so let's keep it going. Let's
Yeah.
keep banging out those exceptionals.
No one's pulled us up. No authority has come down and said you can't do that.
Uh,
Now it's
look,
become the new normal,
It
perhaps.
has, yeah. And admittedly, it reflects the restructuring connected to a part of their business that they want to separate. But this is clearly a mistake that has been made by past management. I'm not
Yeah.
blaming the current management, but past management have clearly messed up big time. They invested in an area. No doubt they've been hugely well rewarded for their mess up. They've gone now. But now shareholders are paying for that, although they won't realize they're paying because it's all deemed exceptional.
Should we
Anyway,
rant
that's my
over?
rant. My rant. That's my rant.
Oh, is it? Because we're going to move on to a pensions piece now, aren't we? That perhaps maybe a second rant for the
No, no,
podcast.
it's probably a second round. Look, we put up a light-hearted thing on pensions lessons from Pixar's Up. And anyone reading the article, it's free to read on our site, pensions
Yeah.
lessons from Pixar's Up. Pixar's Carl Fredrickson, an uncanny resemblance to another famous investor. Have a look at Carl Fredrickson, Pixar's, and another famous investor. Think who comes up. Anyway, it led us on to, we see that the pensions minister is encouraging investment into a wider range of assets, encouraging pensions to invest in a wider range of assets. Clearly, the pensions minister's Torsten Bell is doing this. I'm sure his heart's in the right place. We have our doubts. What do you think about this, where pension managers are being encouraged to do things?
You know, as you quite rightly just articulated there, the issues that you are having around assessing reports, the ability for investors to invest in what they deem will be successful over the next 5 to 10 years should be deemed
On merit, shouldn't it?
on merit,
Yeah.
not because some minister who's probably playing for votes should not tell private investors where to invest their money.
That's my thinking. The focus seems to be on the managers managing defined contribution schemes. These are the schemes of people who are obliged to invest in the schemes, who are following they've been given rough idea of the mandate that the scheme's in. Most of them are probably totally disinterested. And we said most people don't even look at where their money's going, which is somewhat worrying. That's another.
I think we could say it's probably, as a rough guess, a high 90% have no idea what the mandate is for their pension pot.
Exactly.
What and where it's invested in.
But they probably like to think that whoever they're giving their money to is investing it where they think it can generate the best return. Yeah.
Yeah, they probably
So
do trust that element is in there, that the individuals at the other side where that money's going is investing it in
Yeah, so
the
that
best
seems
possible
key to me,
return
yeah.
on investment. Yeah.
Yeah, so now they need to know that, well, perhaps the person managing will be steered towards doing other things that they may not really be in favor of, but that the government would like them to do. As I said, Mr. Bell is saying that he's encouraging, I think, at the moment. It's not actually being imposed. These are massive sums of money, trillions plus pounds of assets. It's the pensioners' future that we're talking about here, their ability to sustain their living in their retirement.
It's quite an interesting situation, really, isn't it? Because in one hand, the government's removing the tax breaks for investors for AIM, so they're kind of de-incentivizing people to invest. But then, on the other hand, they're encouraging the pension funds, DC pensions, to invest in the stock market into companies.
Not just the stock market. Mr. Torsten Bell suggesting they should be investing in private companies. There should be a flow into not just certain stock market, but not just the UK stock market even, but UK private companies, private equity. Yeah.
I'm confused, why is the government not making it far easier for UK companies to make the environment become more successful in the global marketplace, i.e. give favourable taxes in comparison to other competing countries? Energy. The cost of energy is a huge drag on the UK economy and indeed UK companies. So that if they were to go after the energy production for the UK companies and make that cheaper, that would give them a huge competitive advantage. These are the sort of things that then make UK companies far more attractive to investors. Instead of saying, yeah, we've got one of the most expensive energy markets in the world, our regulations and taxes probably could do with a bit of an overhaul in competition with other countries such as US and Ireland as an example.
And not even invest in the stock market, invest in private companies that are potentially the return to the Wild West, which is a very different discipline as well. It's a very different analytical process as well. It needs to do a lot of work to fully understand some of these private businesses. It's not that easy. But it's that prescribed nature of things. I don't think it's like the amateur telling the professional, almost using, to return to my golf analogy, how to play golf. You've got an amateur in this context, in the pensions minister. I don't know if he has worked in the fund management industry or has a real understanding of it. telling the professionals what to do and what they should be doing. And all the time, the poor old beneficiaries of this, the pensioners, they're out on a limb. They won't have a clue what's going on.
Yeah, and
It's
I don't
their
know.
money. It's their money.
Yeah, I guess this gets more into theory, but the UK in particular and the Western countries with the zero interest rates and the quantitative easing of the last 10 to 15 years have certainly helped contribute to the stock market. That's obviously come to an end. We're more in a normal interest rate environment. So, right now, where can we get the next large tranches of cash to inject into the markets rather than looking at the fundamental structure of how these companies
absolutely. I agree. Yeah. Rather than looking at the heart of the problem.
The root cause of the problem, such as energy, regulations, taxes, encourage those types of incentivifications, and you'll probably get the same outcomes without having to force potential future retirees to use their funds to support it.
Well, they see this huge pot here saying,
what can we do with that?
How can we manipulate that? They won't have a clue what's going on anyway. Let's get all the bods on high to do it. People don't understand where their money's gone.
Yeah. Second rant over.
Yeah, absolutely. But I think we should continue to revisit the pension space because it's going to be very live and active, even from an AIM perspective. If they're saying that you could still benefit from the inheritance tax benefit of AIM shares within pensions, which seems possible. So it's even going to cross over into that. But the pension space is going to be very live and active over the next few years.
Perfect. Shall we leave it there then?
Yeah, it sounds good.
And I'll add the link in as well to the article. The pensions lessons from Pixar's up. I'll add that to the show notes below. So if you scroll down, you can have a read through there as well.
Yeah, great. It's a bit of fun.
Thanks, Chris. See you next time.
Thank you.
Well, that's it for today. Please subscribe as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.